All right, welcome. In this explainer, we're going to tackle something pretty fascinating. How in the world does the accounting profession try to put a price tag on things you can't even see or touch? We're talking about the invisible value that really drives some of the biggest companies on the planet.
So let me just start with this question. How much is a brilliant idea actually worth? I mean, really think about that. The value of a company like Apple or, say, Coca-Cola, it's not just in their factories and their inventory. The real magic is in the brand, the patents, those secret formulas. But how do you slap a number on that and put it on a balance sheet? And that's the central puzzle we're digging into today. We're going to dive into the official rulebook that finance pros use to value the invisible, to try and capture the worth of a company's stellar reputation, its loyal customers, or a game-changing piece of software.
Okay, so how do they even begin to tackle this? Well, they use a framework, which you can see right here. Think of this as our map for the next few minutes. We're going to explore these three key pieces: the rules for intangible assets, the really special case of goodwill, and then the journey from a simple idea to an actual asset through research and development. First up, let's just get the basics down. What exactly is an intangible asset? And more importantly, when does it officially get to be counted for accounting purposes?
So the official accounting rulebook gives us this very precise definition. The keywords you really want to zero in on are identifiable and without physical substance. It has to be a specific thing you can point to, even if you can't physically hold it in your hand.
And these examples really make that definition click, right? A broadcast license, a patent for a new invention, or the copyright on a hit song. They're all perfect examples. They are incredibly valuable, but you can't exactly, stick them in a warehouse.
Now here's the catch. Just having one of these isn't quite enough. To officially put it on the company's books, it has to meet some pretty strict criteria. It needs to be separable, which just means you could sell it all by itself. The company has to control it, and probably most important of all, it has to be expected to generate cold, hard cash in the future.
So once an asset makes it onto the books, how do you track its value? Well, there are two main ways. The most common is the cost model. You record what you paid for it, and then you gradually reduce its value over its useful life. That process is called amortization. The other way is the revaluation model, but it's super rare because you'd need an active market, like a stock exchange for patents, which, let's be honest, just doesn't exist for most of these unique assets. Okay, now this is where we find a really surprising and honestly kind of mind-blowing rule. A company is straight up forbidden from putting a value on a brand it created itself. Just let that sink in for a second. The billions and billions of dollars of value in the Coca-Cola brand, it is not actually listed as an asset on Coca-Cola's own balance sheet. Wild, right? And that brings us to a very, very special case. What happens when one company goes out and buys another one? This is where we run into the ultimate intangible asset, something called goodwill.
So what is it? Goodwill is basically the premium you pay when you buy a business. It's the price tag for all the stuff you can't list out one by one. The amazing reputation, the brilliant team, the super loyal customers. It's that magic that makes the whole company worth way more than just the sum of its individual parts.
And just like with brands, there is a massive distinction here. The goodwill you build yourself over decades, that's called inherent goodwill, and you can't put it on your books. The only goodwill that gets recognized is purchased goodwill, the kind that pops into existence during an acquisition.
So the bottom line is this: a company's incredible, hard-earned reputation remains completely invisible, financially speaking, until the day that business gets sold. This is a huge reason why the book value of a company can be so different from what people are actually willing to pay for it on the stock market. Okay, so we've seen that a company can't value its own brand or reputation. But what about its own innovations? How does a simple idea turn into a valuable asset on the balance sheet? Well, that brings us to the world of research and development, or R&D. Accounting actually splits the whole innovation process into two very distinct phases. You've got research, that's the early, blue sky, what-if phase. All the money spent there is treated as an expense, period. But once you move into the development phase, actually applying that research to build a specific product, then the costs can be turned into an asset. But, and this is a big but, it's not automatic. To capitalize those development costs, a project has to clear 6 very high hurdles. You have to prove it's technically possible, that you have the money and the intention to actually finish it, and you can reliably show it's going to make a profit. If you can't tick every single one of those 6 boxes, all that spending is just an expense.
Okay, so we've just gone through a ton of rules. Intangibles, goodwill, R&D. Let's pull the camera back for a second, just ask, why do these specific and, let's face it, sometimes pretty strange rules even exist? Why does this matter?
When it comes right down to it, what's the point of all this? This summary really gets to the heart of it. The entire framework is about one thing: creating a common, consistent language so that when a company talks about its assets, everyone, from investors to banks, is on the exact same page.
Ultimately, it's about transparency and building confidence. In our modern economy, more and more value is being driven by ideas and innovation, not just factories and machines. These rules, as complicated as they can seem, are the best tool we have to help people make smart, informed decisions about where they put their money.
I absolutely love this quote because it just perfectly captures the whole challenge here. Trying to put a hard number on something as slippery as brand reputation or future innovation, it's like trying to photograph a ghost. It's difficult, it's never going to be perfect, but it is absolutely essential that we try.
And that leaves us with a final thought to chew on. As our economy becomes even more dominated by these invisible things like software, data, algorithms, and AI, are these rules, some of which were written decades ago, still up to the job? Are we getting any better at photographing that ghost, or is it just becoming more transparent than ever?